Hello and welcome back to James Talks Property. My name's James, and if you're new here, I'm on a mission to help investors grow their knowledge and understanding of the UK property investment market. Over the last 5 years, I've helped thousands of investors plan and scale property portfolios throughout the UK. I'm the co-founder and managing director of a property investment business, Freighter Property Partners, but this channel is all about helping you grow your knowledge and understanding to mitigate mistakes, all without the gimmicks and any unrealistic promises. Before we get into it, don't forget to hit like, subscribe to the channel and share this to anyone else who might be interested. Today's video is all about how to properly conduct market research and do your due diligence ahead of committing to an investment property. Before you even think about investing in a property, you need to do your homework. Relying on guesswork or a gut feeling is how investors essentially lose money within property investment, and the success of your first few deals will really impact how successful you are with investing in property in the long run. I've seen it so many times where investors commit to something before they're quite ready or before they've done enough due diligence. That deal doesn't quite go right, and then they get scared of property investment altogether and don't essentially hit their long-term goals. Here, I'll walk you through exactly what you need to do before you commit to a deal so you can be confident that you've done enough due diligence so you can commit confidently for your next deal. The first thing you need to do before you commit to a property is research the location thoroughly. If you're not quite sure on where you want to invest in your next property, I have done a video on how to identify UK property hotspots. So I'd recommend watching that one, deciding on a few locations, doing a bit of research, and then coming here to work out how you need to do your due diligence once you know the area of the property in which you're investing. That being said, you don't have to just look in one location. If you have looked at a few different areas and you're happy to invest in 2 to 3 different areas because of those individual fundamentals, then that's also okay. As long as you've done your research and you feel comfortable, then that should be enough. So you've identified the hotspots in which you want to invest in the UK. You then need to make sure that the property that you're looking at is in an area of high demand. Obviously, there's slightly more attractive areas within certain locations. So if you're looking at a specific city or a couple of cities, you need to make sure that the property that you're buying has a demand and has an improving demand because of those fundamentals. You'll want to know the local demand, who lives there, and why people will move there moving forward. You'll check things like the quality of schools, any universities in the vicinity, transport links, amenities, and even potentially crime rates. The way you can do this is go through different tools and resources online to find out all of these statistics and work out if this is a location that you want to invest in. One of these tools a lot of investors that I've worked with in the past have used is property data, but there is a lot of other things that you could use if you want, but I'll pop that link in the description. You then need to look at comparable evidence. The way you'll do this is you'll look at sold prices in the vicinity of the property, not the city. You're looking at sold prices on the street or the next street in and around that property, rental demand and rental values for that specific area, as well as property trends. The easiest way to do that is use things like Rightmove, Zoopla, and the land registry. Something to be aware of is the land registry will have a slight delay on it, but if you go onto Rightmove, you can look at sold prices in that area and make sure that you're not buying over the market value of that property. Do not get caught out by punchy numbers though. You need to look at similar properties that are real comparables. If you're looking at a 3-bed semi-detached or a 2-bed terrace house, you need to compare it with like-for-like properties with very similar square foot as well as the same quality of finish. There's no point comparing a smaller property that needs a lot of work with a property that has a significantly better finish and is significantly bigger. At that point, you're just setting yourself up for failure. One thing you need to keep in mind is, yes, this can take a bit of time, but it's worthwhile doing everything you can to feel comfortable and confident and maximize the success with this. You don't want to risk your money or lose your money with investing in the wrong thing. One thing you need to be really conscious of is you don't want to overpay for this property. Although prices are likely to increase in the long term in most places across the UK outside of the southeast, buying over the market value of a property will mean you'll have to wait a number of years for that property to even catch up of what you've paid for it before you start seeing any growth. This will mean that you'll have to wait a lot longer to refinance that property and release equity to further scale the property portfolio. So do your due diligence, make sure that you know the market value for that property, do not overpay. More properties will come available. Feel comfortable to walk away from the deal that isn't quite right. Do not get carried away and get sucked into that property. Once you're comfortable with both the location of the property and you've got comparable evidence, you then need to go into the nitty-gritty of your numbers. Whether you're doing buy-to-lets, flips, refurb, HMOs, or anything in between, you need to know your numbers inside out. So whether you create a spreadsheet that you can plug your numbers in to work out your yields and your returns, or however you do that, you need to feel comfortable that the deal is going to give you the returns that you're looking for. So, for example, if you're looking at a buy-to-let, I usually go by the rule of thirds with buy-to-let properties. That rule basically means that you'll probably need around a third of the value of the property to be able to purchase that property. And the reason for that is with a buy-to-let, you're going to need at least 25% as a deposit. You'll then need to pay for things like stamp duty, legal costs, broker fees, and anything else within the property. If it's an old property, you might need to pay for a few things like maintenance to make sure it's up to scratch if you're going to rent that out. And if it's a new build, you might have to pay for things like white goods. Within these numbers, you probably will need to speak to a mortgage broker, because if it's a rental property or anything like that, they'll need to stress test the property to make sure that the rent will still cover the mortgage even if interest rates change. Without a specific property, mortgage brokers can only really give you an indicative figure of what rates are likely to be when you secure a property, but if you have a specific property in mind that you want to show them, they can then start speaking to lenders and give you some slightly more concrete figures. And finally, you need to calculate things like hidden costs. So that could be void periods, maintenance, management costs, and everything from that perspective that you might not have looked at until you're looking at a specific deal. Depending on the age of the property, I'll usually factor in anywhere from 5 to 15% for maintenance. And again, depending on the strategy that you've gone for, you're likely to pay for management anywhere from 10% plus VAT, all the way up to 18%, 20% if it's a short-term let business. What I would do is create a spreadsheet, work out what the numbers are that you're going to have to put in, and work out your returns, whether you're focused on yield, return on investment, or anything else. So now you've done all of this, you know you've got the funds to purchase the property, you know it's in an area which is attractive with strong fundamentals, you've looked at comparable evidence, so you know you're paying at least the market value, if not below market value, for this type of property in the area. You now need to go and speak to local agents in the market. Those are people like letting agents who can tell you what that property is realistically likely to rent out for. They will tell you the tenant preferences for that specific type of property in that specific area and talk you through how long the property is likely to be empty before you find a tenant. All of these things are still super important when you're looking at properties, because it will manage your expectations and you'll know what you need to put in the property to maximise the success. For example, if you're buying a prime city centre property in the city centre of Manchester, you're probably going to want to put a furniture pack in the property, because that's what the local market demands. People expect that when they're renting this type of property, and if you don't do that, it might mean that the property lays empty for a few months before you find tenants. In contrast, if you're buying a 3-bed semi-detached house in a commuter area of Leeds, the chances are you probably don't need to furnish it. But again, speak to the letting agent, make sure you know what the tenants would expect, and probably follow their advice. Having said that, it's your property. You can make a decision based on what you believe is right, do your own research, and make sure that you feel comfortable and confident when you're purchasing the property. Once you've done this and you feel comfortable, you're probably there or thereabouts to be able to secure that property. Throughout the buying process, make sure you get a survey done on the property so you know in depth about everything you need to be aware of within that property. And again, this might raise any red flags that might mean that it's probably right for you to actually pull out of that deal. Although this is frustrating and you can lose a few £1,000s when doing this, you'd rather be aware of all the risks involved and lose a few grand rather than tens of thousands of pounds it could cost you if you buy the wrong investment property. So remember, successful investors aren't just lucky, they're prepared. Good research not only gives you the confidence to commit to something, it also protects your investments and helps you scale faster. I've created a free downloadable checklist for you to use every time you're doing your due diligence on a property that you can tick off to make sure that you're comfortable and confident you've done your due diligence before you secure a property. And if you've done all of that, you should feel confident to secure your next investment. And that is everything for today's video. So thanks again, and I'll see you in the next one.